And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? Hope you're doing well. Hope you're taking a little bit of time for yourself. We no doubt have no shortage of news to discuss on today's radio show. Everything from political news to market news to economic news, it seems to be in abundance right now. And it's not to say that we've been in a shortage of headlines really ever since about October of 2024, but it seems as though maybe, just maybe, we might be headed in the right direction. Now, if you're brand new to this radio show, I just want to say welcome to the program. This radio show is really designed to hopefully focus on educating you, challenging the thoughts of the norm, the conventional way of thinking about retirement, and maybe getting you to a position where you can have less risk, and here's the wonderful part, more income. Who couldn't use more income in retirement? And you know, if you're not retired yet, that means that you've got time. But I also want to encourage you not to squander that time. Don't take that time as an opportunity to set things on the back burner, because we all know we do it. We're human beings, right? But the reality is that time gives you an opportunity to get your ducks in a row. It gives you an opportunity to get educated as to the things that you need to have in play before you retire so that you can have the retirement of your dreams. And what exactly is that? My simple definition of a successful retirement is having more income than what you need. And I think most people would agree with me in that definition. Now, that being said, I also don't want to forget those of you that are already retired. We know that for many, they retired and they have lived through this washing machine cycle of everything from COVID-19 to the recovery, to the interest rates going up 11 times, to the elections and the tariff wars, and now potentially the tariff recovery. And you're thinking, I don't know how much more I can handle of this before I just go bonkers. Well, the reality is that we do have ways of being able to improve our situation, even if we've been in retirement for some time. There are ways that we can reduce our risk. There are ways that we can increase the productivity and the output of our money if we only know what those things are. And so whether you're pre-retired, you're post-retired, I encourage you, go to my website, johnsonwim.com. I encourage you, look at the podcasts. I encourage you, listen to the radio shows, look at the valuable assortment of resources and white papers and information that is available to you. I also encourage you, get a copy of my book, The Capitalized Retirement. You can get it from any of the major book resellers at a reasonable price, and it's something that kind of gives you an opportunity to, little by little, learn and digest and implement. Make that book kind of your instruction manual to be able to glean things from it. Does that book, and does it really apply to you in its entirety? Probably not. It's not going to apply to every single person. But let's say that you pick up that book and you learn a few valuable insights, and it challenges maybe some conventional thoughts that you always had. And all of a sudden you realize that you could be improving in, say, just one simple area. Then I think that was totally worth the price of the book. So what all has been going on? Well, obviously, I don't have to tell you. You know that we've been in a back and forth and an up and down. It really has been a bit of a washing machine cycle for the market and the economy. And the market would love to have complete and total insight as to what's going to happen, when and how often and how much. But you know what? This president doesn't feel like sharing all of that. And I suppose in many respects, that is a part of the negotiations and the process that one has to go through in order to negotiate. You can't show all of your hand. You can't show all of your cards. But you know what? It is tough. It's tough for you and it's tough for me because just like the market, we're sitting on the sidelines. We're watching, we're scratching our heads. We're wondering, is this going to be the end of our world as we know it? Is this going to be the end of how society, functions and how the economy functions? Or is this something that we really shouldn't be worrying about? I mean, after all, it's the president and he's worked plenty of good deals. We just need to trust him that he's going to be able to do the right thing for us. Well, I don't know that I would necessarily put all my faith, hope, and expectation in any one politician. You know the old adage, if our lips are moving, that means we're lying, right? And I don't want to make that connotation on President Trump because obviously I don't know him. I don't know him personally. But I do know that if we're in a process where there has been a great deal of inequality when it comes to trade in this country, and we set forth the agenda of fixing those inequalities, there is going to be pain. And there's going to be pushback. There's going to be a bit of a backlash. And we have seen it. But you know what? The market really, really liked what it saw on Monday. Monday, May 12th, that was a big deal. When the news came out that there had been some trade talks that have been going on with China, and now we were going to be taking and seeing Chinese tariffs go from 145% down to 30%. Boy, oh boy, did that do something for the market. That gave everyone a bit of room to breathe. We saw that China decided to reduce its export tariffs, or its import tariffs from us to them. They were going to, charge us 125% tariff into their country, and they've now lowered that to 10%. But talk about the market. My goodness, the Dow Jones Industrial Average jumps 1,160 points, 2.8% in one day. We see the S&P 500 over 184 points, jumping 3.25%. We see the NASDAQ increasing nearly 780 points for a total gain for the day of 4.35%. And what's significant about those numbers? What's significant is if you've been watching the market, which I'm sure you have, since the beginning of the year, that means that literally every single one of those indices, with the exception of the NASDAQ, which is still lagging behind just a little bit, is now even for the year. So trust me, I hear you. It's been a long 4.5 months, no doubt about it. It's been long, it's been grueling, it's been stressful for everyone watching. But the reality is that the market appears to be very much liking the fact that Trump has made good on his deal to come to some sort of an agreement. Now, does that mean that the storm is over? Does that mean we can all come outside now and we don't have to worry about, any more storm weather? Well, I'm not so certain that that would be a smart move. Certainly, it's very optimistic that we've got things in the works and things will probably continue to be ironed out. But we have to be thinking about something called a sectoral tariff. And these are the other areas that we need to be very clear on. You see, when you're a country and you're implementing tariffs, you can have very general, very broad tariffs, but then you can have very narrow sectoral tariffs. And right now, when we think about things like steel and aluminum, right now, we know that the tariff on steel and aluminum would be around 25%. We know that automobiles and auto parts, that's about 25%. So you think about that percentage there, that's even 5% less than the overall general tariff to China at 30%. But then there's other areas, things like semiconductors, lumber, timber, copper, critical minerals, pharmaceuticals. And these are the areas that I want to caution you on. When we look at the market is a very fine representative of emotional trading. I don't think that anyone would argue with me that the market is not a logical place. In fact, it is a very emotional place. And of course, with the massive implementation that we have coming into the market, and this is not something new, it's not something since just, the 2020 or 2024 or 2025. If we look at what has been happening within the financial services realm, we know that software and technology and artificial intelligence has been beginning to take over the trading that takes place on our stock market. And so it is nothing for large major investor institutions to be using artificial intelligence and algorithms and software to be simply, reading headlines. And reading headlines, if it reads a particular headline that has a specific keyword in it, and all of a sudden it believes that that is a piece of factual news, that could trigger a trade. And if you have large trades happening at the same time that many institutions may have their software triggering large trades, now all of a sudden you have the human effect that gets stacked on top. And all of a sudden, before you know it, you have panic selling. I believe that that's some of the capitulated selling that we've been seeing since the beginning of the year. And in the same respect, we have to understand that in software, not only is it responsible for selling based upon keywords and certain parameters and algorithms, but we have to be aware of the fact that software is also being used on the buy side of things. And so if this software, these parameters that these software engineers have plumbed into the trading works of what the institution has, well, if it's reading headlines that read something positive or optimistic, that can also create this idea of, oh my goodness, well, look at all the trading and the buying that's going on. I need to get on the bandwagon too. So what's the point of all of this? Well, we need to be careful because this very well could be just the end of the storm, or it very well could be simply the center of the storm, the eye of the storm. And if you live in Iowa, you live in Minnesota, I know you know what the center of the storm is all about. So as we get back from our first break, I want to spend a little bit of time just going through and looking at some of these things that we have to be very careful of in our own portfolio. Certainly there's opportunities, but certainly there are still many, many risks that present themselves within today's economic environment. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, if you're just joining us, welcome to the program. Today we've been discussing kind of the results of the beginning of this week. President Trump has supposedly brokered a deal with the Chinese, and in this case, it has created a bit of calm and a bit of optimism within the market. The market really liked what it saw on Monday. Now, of course, those gains can be completely washed away by something else that comes. But the big question I have for you is this just the end of the storm, as we all hope that it is, or is it potentially just the eye of the storm? It's just the center where things are kind of calm, things are kind of subdued, but we know that there's more bad weather on the way. Now, when we think about it, going from 145% tariff on imports from China down to 30%, that's a pretty significant move. And China responding with something quite reciprocal, saying, okay, well, we're not going to tariff you 125%. Instead, we will tariff you 10%. I would say that was a pretty good deal. And we know that there are very, very many sectoral tariffs that are still out there, if we think about auto parts and automobiles and we think about steel and aluminum, we know that those are going to be tariffed separately, and we know that those are going to be tariffed at 25%. But the idea here that I want you to really key in on is the fact that we still have many areas, many sectors of ingredients and goods, things that we would produce and we would want to export, things that we need that we would choose to import, that the research is still being done. There has been absolutely nothing that would indicate to us what pharmaceuticals are going to have as a tariff. There's nothing that indicates what crucial minerals and copper and lumber and timber and even semiconductors are going to have for tariffs. And this is very important to us because oftentimes, we have an emotional trigger like this where all of a sudden we see a good piece of news and we think, okay, now it's time to plow back into the market. And of course, we have to admit that even President Trump is not at all shy about encouraging Americans to buy stock. But here is the caution that I have for you. Buying stock is no doubt, or shall we say, it can no doubt be a wonderful asset to own. And everybody wants to own things that can appreciate. And we want to buy those stocks at a good price. We want to be able to see the appreciation over the course of time. But I want to get back to a very basic question for all of you. Those of you that are pre-retired, those of you that are already retired. And that is, why are you saving this money? Are you saving this money because you need it for, some big lump sum purchase, or are you saving this money because you need income? And it really boils down to, what is the objective of the money that you're saving? What is that objective? Because for most Americans today, the idea is anywhere from the ages of 20 to say 60. Your goal is simply growth. Now we have to remember that growth is comprised of two things. Growth is comprised of what I would consider to be an unknown return, and it would be comprised of a known return. Now, let's think about that for just a moment. The unknown return is going to be capital appreciation. We don't know from day to day. We don't know from week to week or month to month or year to year what the market is going to do. We have seen plenty of opportunities, plenty of times in history since the turn of the century and well before then, where we hoped that the market would go up, and instead the market went down. It went the opposite direction. No matter how bad you jump up and down with your pom-poms and you say, go stock market, go. Listen, if there's more liquidations and sales at the end of the day than there is purchases and buys, well, the market's going to go down. And there's nothing you can do about that. But we also want to understand what that known return is. The known return is the interest, the dividends that we get paid. And the reason I call them more of a known, and I understand that dividends from common stock are not guaranteed. I get that. I know that just as well as anyone. But if we have a company, and we have multiple companies, we have multiple different names in our portfolio that are aggregately producing for us 4.5%, 5.5% in dividends, and these companies have a history of paying dividends to their shareholders every year without cutting them. Well, that's, to me, a pretty well-known return. That's something that we can pretty much count on. Now, you get into things like fixed income, things like bonds and preferreds. Those things are even more contractually safe because that's what they are. They're fixed income contracts. But let's say you're 60 years of age. You're not quite retired. Do you just accept 100% what President Trump is saying? Do you go all in? Do you hinge the success of your retirement 100% on what the president is saying? Well, I know that it's very optimistic when the president of the country is encouraging all of us as Americans to buy common stock and to buy the market and to buy American companies in general. I know that that is something that almost feels patriotic, but the reality is we have to get back to the end of the day to say, is he the only one that's in charge? And no matter whether you love him, no matter whether you don't love him, it doesn't really matter. We all know that these tariff deals are not done. We know that there are many, many different things that are still in existence within this whole discussion of tariffs that has not been thoroughly and totally worked through. And so I want to really challenge you that you need to be paying attention more than ever what you're investing in. If you're investing very heavily in pharmaceutical companies, I really encourage you to pay very careful attention, because it feels to me as though even though there's wonderful news with regards to pharmaceutical deals where now President Trump is going to be, putting in action this price equality for pharmaceuticals that Medicare and that we pay. It has to be the same for us as it does for, say, the lowest priced ally that we have. That's wonderful. That's a really awesome thing. But what if you're heavily invested in pharmaceutical companies? These are things that can happen right underneath our own nose, and we'll completely miss it if we're not being attentive. One of the things that is so very important, in the same way that we go to a doctor every single year, or should go to the doctor every year for a physical, in the same way that we take our car to the mechanic and we have the mechanic look over our car and make certain that everything is mechanically sound and is working well. Are you doing the exact same thing with your retirement? It's one of these things where human nature, as it is, says, well, I don't have time for this right now. I'm going to set it. I'm going to forget it. And, I've got a 401k. It's always bounced back. But you have to remember you're now closer to retirement than ever before. And if you're over the age of 59 and a half, you could have potential risk within that 401k that if another country decides to retaliate, we have something silly that happens abroad in another country that significantly shakes the market, and you're about to retire, that could take and jeopardize your ability of retiring. How many individuals in year 2000 wanted to retire and then lost half of their portfolio? What about the people of 2007? They just recovered from the tech bubble burst of 2000 to 2003. They're wiping their brow. They've finally made it back to the previous balance. And all of a sudden, here they go again. And they see 40, 50, even 60% loss in their portfolio. Am I saying that we're going to see another major sell-off? I don't think so personally, but I will never be able to read the tea leaves, and neither will you. And the reality is, this is the reason why we want to be very careful. The closer and closer we get to retirement, we want to be focusing on paying attention to the risk within our portfolio. If you haven't done a risk assessment on what you have in your 401k, if you have not taken the time to run a risk analysis, identifying what you potentially could lose in the various funds that you're investing in, what you're paying for fees and expenses. Because remember, folks, there is no free lunch, right? No matter how many times they tell us it's a no load or it's a low load, well, what does that necessarily mean? And is it really true that the institutions that we're buying are not making any money on our money? We know that that's not true. There is no free lunch. If Wall Street was in the business of charity, I think it would be doing it in a much different way, but we all know that that's not the case. So the third challenge is not only how you're investing and being careful of, are you too overly exposed to these sectoral items that have yet to have tariffs called out on them, But are you paying attention to the objective, and are you paying attention to the interest and to the dividends? Let me give you a short example. Today earlier in the week, I spoke to a woman who has worked for 30 years as a school teacher. And no doubt she had a good long career in the state of Illinois. She had her teacher's pension, and she wanted to retire at the age of 60. Her husband had passed away. She had raised her son by herself. No doubt she earned that ability of being able to retire. But she knew that the pension wasn't going to be enough for her. And of course, if you know things about certain state pensions, we know that if you're a teacher in certain states, you don't pay into Social Security, so therefore you're not going to get anything back out of Social Security. Your pension is your Social Security. But when it came to time to all the money that she had set aside in her 403B and her Roth IRA that she had worked so hard to try to build up to hopefully supplement her retirement pension, little did she realize that she was taking on all the risks that she really was. Little did she know that she was paying what she was. Little did she know that she was making only a pittance of dividends, and she would end up having to sell assets in order to be able to supplement her income. So folks, I'm not going to say that the storm is over. I'm not going to say that this is the center of the storm and there's more to come. But I think that that's more probable. And so be careful, be vigilant, and be aware of what you personally are doing in your retirement so that you can have the retirement of your dreams, a retirement where you have more income than you actually need. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.